Hello class, this is Heather Simpson and I'm here to work through exercise 811 with you. So the first thing I like to do is put in the dates. Helps me to keep organized and keep things straight. So I'll put those in right now. And then, so let's read it. It says May 1st, up here we're reading, May 1st received a $4,600 note, 12 months, 3% in exchange for an outstanding account receivable from R. Stoney. So there is already an account receivable on the books for this account, and we're transferring it over to a note. So that means that we're going to debit our notes receivable. Notes receivable is an asset, so we debit it to increase that account because we're creating it. And we debit it for the face value of $4,600. That's the amount that they owe us. And then we want to credit accounts receivable because we're transferring it, we're changing it from accounts receivable to notes receivable. So we have to decrease accounts receivable by that amount to show that it's been switched over to a note. Hope that makes sense. Okay, so December 31st, accrued interest revenue on the R. Stoney note. So we're not actually receiving cash, we're just recognizing that at the end of the year, in preparation for let's see, it says the company does not make entries to accrue revenue or accrue interest except at December 31st. So that's what we're doing. We're just showing that interest that is building, but we haven't actually received cash for it yet. And so we've got interest receivable, meaning that's going to happen. We're going to receive it down the road. And we need to know how much that interest is. So let's go to Excel. And we're going to put in the face value of the note. It was $4,600. And the time in months, it was 8 months has gone by up until December 31st. It's not the full term of the note, but 8 months has passed. So it's 8 divided by 12. And then the interest rate is that 3%, and that gives us $92. So back to Wiley, and we are going to put in $92 because that's what we're expecting to come in to us, or we're going to receive that for this portion of the note. And interest revenue is going to be credited because we want to increase that account. Interest revenue, revenue accounts increase with a credit. So we want to recognize that we are earning revenue from the interest. Okay, sorry, I feel like I'm talking too much. Anyway, moving on. On May 1st, we're receiving the full payment. So this is going to be cash that we are receiving, and we debit cash because it's an asset that will increase it. And that is the full amount that we are receiving. So that's going to be the notes, the original amount of the note plus all of the interest. And we credit notes receivable because we want to decrease that account. Because it's being paid in full, we need to get that off of our books, that it is no longer owed to us. So we're going to credit notes receivable for the $4,600 because that's how much, that's the face value. You always use the face value for notes receivable. And we've got interest receivable. Yeah, and that's going to be the $92 that basically we're erasing it from here. I hope this is making sense. So on this line, on December 31st, we debited it. Now we're going to credit it because it's no longer receivable. We are actually receiving it. So it's not on its way to us. We've got it in hand. So by doing that, we're equaling out the equation. Okay, so now the interest revenue, this is going to be from January 1st to May 1st. So this is like the other portion of the note receivable. So we're going to go back over to Excel and do some calculations. We've got the $4,600 is the face value of the note. Now, this was 4 months from January until the when we received payment. So it's 4 divided by 12. Interest rate is still 3%, and we've got $46. coming to us. So interest revenue, we're going to credit $46. And remember, revenue on a revenue account, crediting increases that amount. So basically what we have is the $92 of this interest revenue right here, and then the $46 of interest revenue. If you add those up, plus the note receivable, you end up with the cash that we received. And it was all correct, so that's good. Hey, this has been great. Thanks for listening. Hope that I didn't ramble on too much.